Hello and welcome everyone. If you're a student or a young professional, chances are, you've thought about how to make your money work for you. It's never too early to start thinking about your financial future, and today, we're going to be talking about some important concepts that can help you start your investment journey. We're going to discuss 5 surprising investment facts that all students should know about, and these include the concept of passive income, the importance of investing early, the benefits of low-cost index funds, understanding ETFs, and the financial independence, retire early, FIRE movement. These concepts may sound complex at first, but don't worry, we're going to break them down in a way that's easy to understand and hopefully inspire you to take the first steps towards your financial future. Passive income is a concept that many people find appealing, and it's easy to see why. The idea of earning money with little to no ongoing effort is certainly attractive. But what does it really mean to earn passive income, and how can one do it? By definition, passive income refers to earnings derived from an enterprise in which a person is not actively involved. Unlike active income, such as earnings from a traditional 9-to-5 job where you're trading time for money, passive income flows to an individual with little effort required to maintain it. Passive income has been a relatively loosely defined term historically. However, for practical purposes, we can define it as money earned on a regular basis with little or no effort required to maintain it after the initial work has been done. This doesn't mean it requires no effort to create. Quite the contrary, creating a source of passive income often requires significant upfront work. One of the most popular sources of passive income is real estate. This includes earnings from rental properties, where landlords collect rent from their tenants. Once the initial work of buying and preparing a property to rent is done, landlords can earn a steady income with minimal ongoing work. Real estate investment trusts, REITs, also provide a way to earn passive income through real estate without the need to own property directly. REITs are companies that own, operate, or finance income-producing real estate, and investors can buy shares in a REIT, making it a more accessible form of real estate investment for many people. Another common source of passive income is owning or investing in a business. For example, if you own part of a business but are not involved in its day-to-day operations, the profit that business generates can be considered passive income. Similarly, if you're an angel investor who provides financial backing for small startups or entrepreneurs, the returns on your investments would be passive income. Investments such as stocks, bonds, and mutual funds can also generate passive income. Dividend-paying stocks, for instance, provide a stream of income that continues as long as you hold the shares. Bonds pay interest to their holders, and mutual funds can generate income through a combination of dividends and capital gains. All of these investment vehicles can produce a steady flow of passive income, especially when they're held over the long term. Passive income can also come from more creative sources. If you write a book, for example, you'll put in a significant amount of work up front. But once it's published, you can earn a steady stream of royalties with no further effort. Similarly, if you invent a product and patent it, you can earn passive income through licensing fees. In conclusion, the concept of passive income is all about leveraging your resources, whether it's money, property, or intellectual property, to generate a steady income stream with minimal ongoing effort. It can require significant work up front, and it's not without risks. However, for those willing to put in the time, energy, and resources to create a passive income stream, the potential rewards can be significant. The importance of early investing is something that cannot be overstated. Investing early in one's life can have a substantial impact on one's financial future. There are a few key reasons why this is the case. The first is the power of compound interest. Compound interest is the interest earned on both the initial amount of money put into an investment, known as the principal, and any interest that has previously been added to it. This concept is often referred to as interest on interest, and it can lead to exponential growth of wealth over time. When you invest early, you give your money more time to generate compound interest. This is one of the main reasons why starting to invest at a young age can be so beneficial. Even modest contributions can amount to significant sums over time. For example, someone who starts investing $200 per month at the age of 25 will have significantly more by retirement age than someone who starts investing the same amount per month at the age of 35, assuming the same rate of return. The second reason is the ability to take on more risk. Younger investors, in general, have a longer time horizon to invest, which typically allows them to take on more risk in their portfolios. Investments with higher risk often come with higher potential returns. While these investments might also experience more short-term volatility, younger investors have the luxury of time to ride out any short-term downturns in the market. Thirdly, investing early allows for learning from mistakes. Every investor, no matter how experienced, will make mistakes. By starting to invest early, one has the time to learn from these mistakes and make better informed decisions in the future. It provides a buffer zone to recover from any potential financial downturns or poor investment decisions. Another crucial aspect of early investing is the development of financial discipline. Regularly setting aside a portion of one's income for investments instills a habit of savings and careful financial management. This discipline can have far-reaching impacts on all areas of one's personal finance. Additionally, early investing opens up the potential for achieving financial independence at a younger age. Financial independence is often defined as having enough income to cover living expenses without being employed or dependent on others. This can be achieved through the accumulation of a substantial investment portfolio that generates enough income to cover expenses. In conclusion, the importance of early investing lies in its ability to harness the power of compound interest, tolerate higher risks for potentially higher returns, provide room for learning from mistakes, instill financial discipline, and pave the way towards financial independence. It is never too early to start investing. Even small amounts invested regularly can lead to significant wealth over time. For the young investor willing to take a long-term perspective and remain consistent, the benefits can be substantial. Index funds are a type of investment fund and exchange-traded fund, ETF, with a portfolio constructed to match or track the components of a market index. Examples of such indexes include the Standard & Poor's 500 Index, S&P 500, or the Nasdaq 100. The purpose of an index fund is to provide broad market exposure and generate returns that follow the performance of the selected index. One of the primary benefits of low-cost index funds is their affordability. Traditional mutual funds are managed by professionals who analyze and select the stocks. For this, they charge fees, which can significantly cut into an investor's returns over time. On the other hand, index funds are passively managed. They simply mirror the index they're tracking, meaning there's less need for active management and, as a result, lower fees. This cost-effectiveness makes index funds an attractive option, particularly for investors who are just starting out and might not have a large amount of money to invest. Index funds also offer a high level of diversification. By mimicking a market index, an index fund typically invests in a wide array of companies across various sectors of the economy. This diversification helps reduce the risk that comes with investing in individual stocks. Even if one company in the index performs poorly, the effect on the overall fund is usually minimal because of the presence of many other companies in the fund. The passive management strategy of index funds also tends to result in lower portfolio turnover. Portfolio turnover refers to the frequency with which stocks are bought and sold in the fund. High turnover can lead to higher transaction costs and create taxable capital gains, both of which can erode returns. Since index funds aim to mirror a market index, they typically have lower turnover than actively managed funds, as they only need to make trades when the composition of the index itself changes. Another benefit is transparency. It's relatively easy for investors to understand what they're investing in with an index fund because the fund is simply tracking a known index. This transparency means investors can always see what securities the fund holds, and they can easily track how closely the fund's performance matches that of the index. Lastly, over the long term, many index funds tend to outperform actively managed funds. This might seem counterintuitive, as actively managed funds are overseen by professional managers who aim to beat the market. However, it's been found that after accounting for fees, the majority of actively managed funds do not outperform their benchmark index over the long term. In conclusion, low-cost index funds offer numerous benefits to investors, including affordability, diversification, lower portfolio turnover, transparency, and potentially higher long-term returns. They are an effective tool for investors of all types, whether you're a beginner starting with a small amount of capital or an experienced investor looking to broaden your portfolio. By capturing the broader market's returns at a low cost, index funds can be a core component of a successful long-term investment strategy. Exchange-traded funds, ETFs, are a type of investment vehicle that has gained popularity due to their unique blend of characteristics drawn from mutual funds and individual stocks. ETFs are similar to mutual funds in that they represent a collection or basket of securities, such as stocks, bonds, or commodities. However, unlike mutual funds, ETFs are traded on stock exchanges, just like individual stocks. The first benefit of ETFs comes from their tradability. Unlike mutual funds that are priced and can only be bought or sold at the end of the trading day, ETFs can be bought and sold throughout the trading day at market price, just like individual stocks. This flexibility allows for a greater degree of control for the investor and can be beneficial in a rapidly moving market. ETFs also offer high levels of diversification. Like mutual funds, they allow you to invest in a diversified portfolio of many different securities. Depending on the ETF, it could be composed of hundreds or even thousands of individual stocks, bonds, or other assets. This wide array helps mitigate the risk associated with investing in a single company or sector. Cost efficiency is another significant advantage of ETFs. Many ETFs are passively managed, meaning they aim to replicate the performance of a specific index rather than outperform it. This passive management results in lower operating expenses, as it reduces the amount of analysis and trading required. Lower expense ratios mean more of your investment stays in your pocket, potentially leading to higher returns over the long term. Tax efficiency is another benefit offered by ETFs. Due to the unique, in-kind, creation and redemption process of ETFs, they are often able to minimize capital gains distributions, thus offering potential tax advantages. This means investors may owe less in taxes compared to other types of investment funds. ETFs also provide transparency. The holdings of an ETF are disclosed daily, so investors always know what assets they own via the fund. This transparency is beneficial for investors who want to ensure that their investments align with their financial goals, risk tolerance, and ethical or social values. The range of investment choices is another feature of ETFs. They provide access to a variety of sectors, commodities, markets, or investment strategies, offering an easy way to diversify across different asset classes and geographical areas. There are ETFs available for virtually every type of asset class, from traditional investments like stocks and bonds to more niche areas like cryptocurrencies or specific sectors or industries. In conclusion, ETFs combine the diversification benefits of mutual funds with the tradability of stocks, offering an efficient, flexible, and diversified investment vehicle. Their range of options, tax efficiency, transparency, and lower costs make them a powerful tool for both individual and institutional investors. However, as with all investments, it's crucial to understand your investment goals, risk tolerance, and the specifics of the ETF before investing. The concept of financial independence, retire early, or FIRE, is a lifestyle and financial movement with the goal of gaining sufficient personal wealth to allow for retirement from traditional work at an earlier age than typical retirement benchmarks. This concept is centered on saving aggressively and investing wisely to achieve this goal. The first element of FIRE, financial independence, refers to accumulating enough assets to sustain one's lifestyle without the need for further employment or reliance on others. Essentially, it means having enough income-producing assets to cover living expenses indefinitely. Retiring early, the second element, is a more personal concept. For some, it might mean completely leaving the workforce, while for others, it could involve part-time work, freelancing, or even starting a passion-based business. The key point is that early retirement, in this context, refers to having the financial freedom to choose the type of work you do and the amount of time you spend doing it. There are three main types of FIRE strategies: lean FIRE, fat FIRE, and barista FIRE. Lean FIRE advocates for extreme frugality to save and invest as much as possible, while fat FIRE promotes achieving financial independence with a more substantial budget that allows for more luxuries in retirement. Barista FIRE involves achieving financial independence but continuing part-time or flexible work to cover current expenses. One of the primary ways people pursuing FIRE achieve their goals is through a high savings rate. This often involves aggressive budgeting and a frugal lifestyle to maximize the amount of income that can be put into savings and investments. The exact savings rate can vary, but it's not uncommon to see rates of 50% or higher among those in the FIRE community. Investment is another crucial part of the FIRE strategy. Money saved is typically put into low-cost index funds, real estate, or other income-producing assets. The goal is to generate passive income that can cover living expenses. However, pursuing FIRE also requires careful planning and consideration of potential challenges. Healthcare expenses, market fluctuations, and unexpected life events can impact one's ability to maintain financial independence. It's important for anyone considering this path to plan carefully, ideally with the help of a financial advisor, to ensure they're prepared for these potential challenges. Moreover, some critics of the FIRE movement warn that it might not be suitable for everyone, particularly if it leads to extreme frugality that reduces quality of life. Each person needs to consider their own values, lifestyle preferences, and financial circumstances when deciding whether this path is right for them. In conclusion, the FIRE movement offers an alternative to traditional work and retirement structures. It involves a high savings rate, careful investing, and often, a degree of frugality. However, for those who value financial freedom over material wealth, the prospect of gaining independence from traditional employment can make these sacrifices worthwhile. With careful planning and the right strategies, FIRE can be an achievable goal. And that wraps up our discussion on these 5 key investment concepts. We've covered quite a lot today, from understanding the power of passive income, recognizing the significance of investing early, realizing the benefits of low-cost index funds, getting a grasp on ETFs, and learning about the FIRE movement. Remember, the journey to financial independence and smart investing starts with knowledge. The sooner you begin, the more time you have to grow your investments, learn from your experiences, and adjust your strategies. Remember, everyone's financial journey is unique, and what works for one person might not work for another.